Welcome to this episode number 26 of Your Next Trade. I hope you got a good Easter break. I took some time off of the market. Now I'm back. I call this episode Eurodollar Game Over. Why? Because the Eurodollar contracts that have been used by market participants since the early 80s are now moving into a new product, which is called the SOFR, which is the Secured Overnight Financing Rate. So as we can see in this chart here, you see the volume of the Eurodollar has been slowly but surely coming down, and now the SOFR contracts have been picking up. So that doesn't mean there is a change. It's just that for those of you who have been following the LIBOR scandal, where some banks have been manipulating the LIBOR, and it has been the market has been looking for a new product, and the SOFR product is the follow-up or the new Eurodollar. So this is not the Eurodollar, the end of the Eurodollar for the currency. It's more like the new product, and as we're going to see in one of the tabs today, this SOFR are a really good way of pricing how the Fed is going to be doing in the future, or at least how market participants think that the market is pricing. So if we look at, since we spoke like 3 weeks ago, the market is still into a risk-on. Stocks have been higher, both in Europe and the US. The dollar has been weakening versus most currencies. So there's a lot of noise on Twitter and on social media. This is the end of the US dollar. This is not necessarily the end of the US dollar. It's more like the 80% roughly of all the transaction in dollar could get lower. Not the end of the dollar, as I said just before. More like maybe we're going to see less transaction in US dollar. But for the time being, there is no replacement to the US dollar. If you look at commodities in between, so at the start of last weekend, the OPEC decided to reduce the production. So now the WTI oil is trading above $80. So what is funny is the people who have been telling, the world is restarting, we're gonna have a huge demand. This is why you should be long the WTI. That has nothing to do with it. It's mostly because if you look at oil, you should be looking at, for any commodities, supply and demand, and supply and demand is roughly around 100 million barrels per day. So if the OPEC through Saudi Arabia and Russia is cutting this production by 1 billion to 1.5 million, or 1% to 1.5%. That is roughly what you should have in terms of growth year on year. So that explains most of the growth. But let's jump immediately into what we have in terms of year-to-date asset performances. So this chart is pretty much distorted by two things, which is the cryptocurrencies and the natural gas. So natural gas, both in the US and Europe, are down 50%. Why we have been keeping those two is because you know that due to the Ukraine conflict, natural gas was really one of the drivers at the start of this year. It has been done massively, so that has been helping the market. On the other end of the spectrum, with the winners, we see that crypto through Ethereum up above $2,000 and Bitcoin up to $30,000. I don't think this is much of new money coming. It's just that it's very hard for professionals and funds to get exposure to that space, but you don't need much for crypto to go higher. If we look at stocks, which are the light blue, now S&P is up roughly 8%, Nasdaq 16%, which is roughly the same performance as the Euro Stoxx 50. So a risk on for stocks that has been very strong, very and true for the last couple of months. If you look at Europe, we have been bouncing back by 10% since the lows that we had after the Credit Suisse and the regional banks issue in the US. US dollar weakening roughly 2 to 3% versus most currencies year to date, and then the gold up 10%, so up now above the $2,000. It is testing a very important level if you look at technical analysis, and this is why people have been saying, you should go short. So this is the I think it's 2050 levels, which is more or less the triple top, maybe maybe we should look at it in technical analysis. And the copper this week as well, so up 7.8% for the week, so for the year. What about the week to date asset performances? The story is still the same. Crypto very, very strong, and stocks that have been in the mode of risk on. So risk on. The story is still the same. Bit of dollar that did a reversal actually on Friday. So yesterday was very strong until we had yesterday was the retail sales numbers, and after the retail sales, literally the US dollar started to weaken. So always try to find of change in the markets. So this is why we look across asset classes to see if we could identify something that is changing in the trend. And the US dollar, that's only one day, is not a trend, it's just a start. But US dollar has been I should say strengthening at least on Friday's afternoon. So what about the year-to-date industry performance? And I like to be looking at the S&P, which is roughly here. So what the industries have been doing versus the S&P. And so as you can see here, this is still the same regional banks and the banks. So we had many already earnings yesterday with JP Morgan, Citigroup, and Bank of America, where the banks did pretty well, both in terms of EPS and revenues, and the price action was very strong. But the issue is more on the regional banks. We know that the money has been flying from regional banks into the safer banks, the big banks, where because they are too big to fail, American depositors feel very much more secure to put their money in a JP Morgan, Bank of America, because you can't see those banks fail. Even if in the US, the recent history has been showing that it's very hard even for small regional banks to fail because of the regulator. So semiconductors still very strong. Chart that we're going to be looking, actually semiconductors are not the leaders over the last couple of weeks. So a bit of waiting for the earnings coming in. Week to date industry performance. So we get the 20 years treasury with the TLT quite weak. Why? Because the yields have been a bit higher. Gold flattish. So this is here for this week we had a lot of noise, but gold is only flattish because we had a big move and a bit of a reversal at the end of the week. And interestingly, if you look here at the right hand side, we got home builders. We got many sectors that telling you that the cycle could still be very much alive. What about the sector's performance on the year to date and the week to date? So year to date, we have the financials and the defensive ones to the healthcare and utilities that have been struggling. IT, telco, very, very strong. Consumer discretionary. Week to date, interestingly, you see the retail, the real estate, and here the utilities that are both negative. Why? Because yields have been kind of bottoming, and now there has been a question of, are we going to see inflation back again, and is the Fed going to stay higher for longer again? So what does that mean in terms of rates? So rates here, looking at the US 10 years, you see the week to date, we are up 12 bips, and that explained a bit why utilities were weak over the last 5 sessions. Same for real estate. So we are 3.5% on the US 10 years. So if I don't like to be doing any technical analysis on yields, but you can see this is recent low levels over the last 6 months, the 340, 350% for this 10 years. In terms of yields to go lower, you really need inflation to come lower, or the Fed to be more talking about actually taking a step back from doing more. What about the inversion of the yield curve? We are down to minus 0.53 bips. So that tells you that we came back here. So this is the chart here. We came back from the minus 1%. We are still very much inverted, meaning that this is not good for regional banks. And as a leading indicator, this is still a strong leading indicator that the recession might be coming. So now looking at the secure overnight financing rate, the SOFR, which is now replacing one of the spreadsheets that were not spreadsheet, a tab that we had before. We are using Eurodollar, but as I said, the Eurodollar contract futures are now being replaced by this new contract. And why is it helpful? Because that tells you what the market participants are pricing in terms of Fed expectations. So if you look at the CME website, and if you look as well at what is the market pricing for the May meeting, which is on the 3rd of May, now the market is roughly pricing an 80% chance that we're going to have plus 25 bips from the Fed at the start of May. Then after that, if you compare the June, which is at 94, 97, versus your December 95.59, that means you get roughly a differential here of plus 0.6. Plus 0.6 means market participants between June and December are expecting the Fed to be cutting rates by 60 bips, which is 2 times 25 bips plus half another 25 bips. So in other words, so far, right now, you have the Fed telling us, no, inflation is still strong. We are going to stay higher for longer. We're going to have the H2 actually we're not going to be cutting. And the market is saying, oh, no. In December, we're going to be much lower. And as we can see, the cut keeps on coming down. Cuts coming down means two things. It means obviously that inflation should be lower, but as well that means that the odds of a recession coming are on the way up. And if you look at what the Fed has been saying over the last couple of weeks, both by their own analyst and actually from, I can't remember which Fed speaker we had this week, but I think it was Bostich, saying that now the Fed is more and more pricing a chance of a mild recession into H2. Why is it so important? Because when you have recession, that means, in other words, your earnings are not growing. When earnings are not growing, it's very hard for the S&P to go much higher. What about the VIX? So I added something new. So here at the top, we get the VIX since January 2022. What is interesting is, as you can see, we have been making new lows, and that is the 17% here that we have. For those who have done the 4x4 video series, you know about the 16% rules. The 16% rules tells you that the market is more or less pricing a 95% chance that the S&P will be moving by 1%. So VIX through the 30 days volatility is now, market participants are saying, volatility for the next 30 days is going to be very low. If you look at the VIX term structure, it's going higher, which is pretty healthy normally when you see those kind of VIX term structure. But I added the VIX 9 days. Why? Because the market is more and more driven by short-term options. We have been covering in different videos the zero day to expiry for options. We know that 50 to 70% of the daily options now are options that will be expiring today or tomorrow. So as the market is more and more driven by these short-term options, we need to be monitoring and following indicators that are telling us how the implied volatility, even more short-term than 30 days, is doing. And you can be using the VIX 9 days. You can go on investing.com, that you're going to have the numbers. So similar here. We are now at 13.35, so this is a new low here. So implied volatility, and as we're going to see later, like the realized volatility is really coming down. We are back to levels that we had literally a year ago or 2 years ago. So market is very friendly, and actually each time that you have a jump in volatility based on numbers, based on Fed expectations, what we see on an intraday basis is this implied volatility to the VIX will get hammered, and coming with volatility getting hammered, you get two things that are happening. The gamma is kicking in. That means you have a lot of buying pressure, on the futures and on the contracts. And in the meantime, if you look at longer term, when volatility comes down, if you look at your risk metrics, so if you based your ATR, if you base your volatility on the last 250 days, and day after day your volatility is coming down, that means based on those models, you will have a tendency to increase exposure. So what has been happening these days is funds and traders and long-only players have been increasing their exposure because volatility has been coming down. And it goes both ways. When volatility goes up, your models will be showing obviously higher volatility, and you need to decrease your gross exposure and your net exposure. So let's jump quickly now into the technical analysis, starting as always with the S&P 500. So what is interesting is we are back to the levels that we had at the start of February, where we had a bit of a hoo-ha-ha moment. We are still way above this downtrend, which has been pretty well working as a support. So let's watch now this 4200 level for the Nasdaq. The picture is the same. We have been trading and consolidating. What we are all waiting for now is the next catalyst, which could be the earnings. Russell, on the other end of the spectrum, is still weakish. The reason is still the same, with the regional banks down 20% plus over the last couple of months. That is not helping. And if you look at the Nasdaq versus the Russell, same, we are consolidating. Same picture here in terms of consolidation between the generals, the leaders, the big companies, the mega companies, the Meta, the Amazon, the Apple, the Microsoft versus the S&P. We had a big move from January until end of March, and now we have been consolidating. So market is waiting for new catalyst. On the other hand, Europe, and I'm still short Europe and I'm still suffering, is making new highs, both on the stock 600, the DAX is making new highs, and it's grinding in very volumes. If you look at volume, so I look at volume every single day. For instance, on the French market, every single day the volume will be the same, which tells me that it's a kind of passive investment plus, as I said, vol control, where as volatility is coming down, you get new money coming. It's not necessarily big new players, but it is grinding higher. CL1, so that is for the WTI. This is for oil. We are very much at the top of the recent trading range, which was between 82 and 72 before. As I said, when we look into the 65, that was a good entry level, at least if you were short to close the position. Now I think it's going to be mostly about China and how China is going to do, and obviously other currencies are going to be doing. But if you look now at the copper futures, the kind of a weakish day, weakish session on Friday, so not a strong follow, and it's not making new highs. Definitely it's lower highs, which is not positive. Eurodollar, so this is the interesting chart. As I said, we went from 106 to 110 in a month, so very strong move, 3 to 4%, and less move. And on Friday we had the first candle. First candle is not, the red candle is not a trend, but that is something to watch for the following days. I would like as well to mention JP Morgan, because JP Morgan was very, very strong yesterday. During the session and at the close, so closed up 7.5%. And interestingly, if you look at the last 20 earnings, normally what JP Morgan does is it opens very weak, and actually only the last couple of earnings it managed to do well. So very, very strong earnings and very strong price action. So next 2 to 3 weeks, it's mostly about earnings in the US. The first reaction from the banks has been very positive. You can argue, as I said before, that most of the money from regional banks has been switched into those big banks, and they have been benefiting from it. And obviously, with the 10 years and the 3 months, the 6 months, the 1 year in the US at 5%, they are making good money. So they have been benefiting from that. But the regional banks, the picture is still the same, and actually a bit of deterioration. We could be making lower lows very soon, and that means we need to be following up how those price action will be during this earnings season. As I mentioned, with the when we look at the performances of the industries, so this is for the SOX index, which is Philadelphia Semiconductor Index, so not making new highs. As you remember or not, looking at 2023, the start from 2023, we went from 2,500 to 3,200, so a 25% move, almost one-way traffic, but not a leader these days, because if that's a leader, obviously you are outperforming the market, so you can do something like this. You do a SOX versus the S&P, just to confirm that it is not making new highs. Bit of topish. Again, this is not a trend, but if we want the market to go higher, we will have to find those new leaders. And for the time being, this is not the semiconductor. So let's look at what has been happening this week, starting with the S&P futures over the last 5 sessions, trying to give you a bit of color. So we had the Monday here, the bit of very low liquidity. More interestingly, we had the CPI that was lower and the PPI that was lower. So first the CPI, which was on that day, we moved higher, but then we had the Fed minutes, and the Fed minutes were still saying the same. The Fed will be higher for longer, that they are still looking at inflation. So first reaction on the day was, okay, we like the lower inflation, the CPI, and then it was, oh, actually, it's still very high inflation. We are talking plus 4% year on year. The month on month is a bit coming down versus the other months. If we look at, we are talking plus 0.3% versus what used to be plus 0.5%, but still very high inflation. Then we got the Thursday kind of crazy move where we had the PPI, which was a bit lower, and then we had the grind into the weekly OPEX with not much of participation, not much of volume, but the market goes higher and higher. Then on Friday, what happens? We get the retail sales. So here, this is the retail sales. And as you can see here, this is the month-on-month retail sales. So the headline number was worse than expected. The core retail sales were actually a bit better. So we were only down 0.3% month on month. But that tells you that if you still want to believe that the US GDP is 70%, 80% made of the US consumer, if the US consumer is struggling, then the US economy might be struggling. So we had the seasonality effect or the hoo-ha effect in January, and since then we have been coming lower. That was well flagged, but that tells you a lot about the US consumer and what could be happening in the next few months. Coming back into the expectations and should I say the inflation, the market here, this is for the SOFR, where we had one number from the University of Michigan, which is giving you from some consumers in the US what are the 1 year expectations, and we had a big jump from roughly 3.6% to plus 4.6%. So some scare of inflation is still very sticky, that it could come back. So I think the question for me now these days is very much the following: is the sentence which is "don't fight the Fed." So "don't fight the Fed" these days is for me about saying two things. First thing that I mentioned before is, are we going to stay higher for longer? And you have a lot of Fed speakers saying if inflation is too high, don't expect, rates to come down in H2. Okay, so that's the first thing. And on top of that, they are saying, with inflation, we are more and more forecasting, or Fed is telegraphing a recession into H2. So far, they are hoping and they are doing pretty well at having a mild recession. But a mild recession still means that your earnings are not going to grow, and you are more and more taking the risk of, obviously, a hard landing. So if the Fed is saying we're going to stay higher and you're going to have a recession, please don't tell me that we're not going to have a recession, because you're fighting against everything. So what about the earnings day move that I mentioned? So this is JP Morgan. As you can see, the last 3 earnings days. So what I like to do when I go into earnings season and when I'm long or short some stuff, generally I don't like to go and having too much exposure going into earnings, because I think this is much more of a casino. But I want to know before how the stock has been behaving before. And last three earnings, JP Morgan has been doing very well, plus 7.5% yesterday. So that tells you the first part. So we always start the earnings season with the banks, and that gives you a bit of color of how the economy has been doing so far. Pretty well, but as I said before, I think there is a lot of the reason is more or less a lot of money has been moving from regional banks into those banks, and that doesn't really tell us about what is the big picture for the US economy. So looking at this picture, what are the catalysts going forward? So the market is going higher and higher, but actually the participation is not that big. It's very hard to clearly identify leaders. This is everyday grind with lower volatility. So volatility is coming down and down. So if we look here, this is the 10 days realized volatility of the S&P 500. So when we look at volatility, this is something that we explain in details in the 4x4 video series. There is the implied volatility, which is so we have the implied volatility, and we have the realized volatility. The implied volatility is what the market is pricing in the future, and the realized volatility is obviously how the market has been behaving over a certain period. So if we look over the last 10 days, realized volatility for the S&P futures, we are now around 10%, and we have been making new lows here. So both the realized and the implied volatility have been coming down. If you look at the S&P here, weekly straddle 1.4%. That is quite something. That tells you that the market is roughly expecting not much happening for the next 5 days. But next 5 days, what's going to be happening, or next 5 sessions, is we have the earnings. So earnings, 61 S&P 500 companies, which are making roughly 14% of the market value. And you're going to have some interesting name. We're going to have Schwab, we're going to have Netflix. So I highlighted some of the names: Tesla, Microsoft, not Microsoft, Morgan Stanley. So that are the names that I'm following. I always try to identify some of the market leaders, and as well the biggest industries leaders. Okay, so the big names, and that's going to give me a picture of what's going to happen in the next few months. Macro-wise, we're going to have the Chinese GDP and the Chinese industrial production on Tuesday. More importantly, we get the flash PMIs on Friday and some Japan inflation. Always look about the Fed speakers as well. So we're going to have one on Tuesday, more on Thursday. But I think the most important thing is the market is very much driven by those options and this grind into the 4150, 4200. So there's a lot of open position around 4150. And on Wednesday, we get the VIX expiry. So the VIX futures will be expiring. Then we get the options expiry on Friday. So that could, as always, for market to change direction, you need a reset of positioning. That is very much, if you don't have any new news, if you don't have something big happening, you need to have a reset. And the natural reset for this market that is very much driven by options is when both the VIX are expiring and the options are expiring. So if you want to go long volatility, that might be the time, because as we have seen, we are at quite a low level over the last couple of years, and we could see actually some reaction on the downside for the S&P and for the other equity markets. I'm kind of a bit of talking my book here, but this is the idea. And finally, coming back on the earnings. So here, this is from Refinitiv and from FactSet, looking in dark blue about the the EPS expectations from the market, which have been lowered by 6.3% between December and March. So the bar on the S&P EPS and on the overall of the market earnings has been lower quite a lot. So always check if how these earnings were priced 3 months ago for a company, because if they have been lowered by 15% over 3 months and they just beat by 3%, this is not really a bit. And reality is, these days we know that it has been lowered by quite a lot. And I think interestingly, and I think for me this is the what to be looking at is for H2. Why H2 market is still very much pricing a strong H2 earnings growth, whereas in the meantime we know that both the Fed and the market participants are more and more pricing a recession, a mild recession to a strong recession, a hard landing, but that is very hard for me to adjust the two. So this is it for me for the week. If you have questions, I can probably help you answer those questions. I built the 4x4 video series, which is an investment process based on my experience, 20 years experience, both in education and trading the market, prop trading, hedge fund, long only. And I do as well mentoring for more advanced people and people who would like to have one-on-one session with me. For the free stuff, you can have access to the Discord community. Please feel free to join, ask questions. I hope it helps some of you, and I would like to keep this community, really helpful between traders. This is it for me this week. I hope to see you next week, and talk soon. Bye bye.